We're joined by Dr. Narayana Kocherlakota. Thank you so much for joining us. I know it has been very busy. The action will only ramp up tomorrow there in Jackson Hole. But first off, sir, what action do you think the Fed should take with interest rates at the September meeting?
So my outlook for inflation is that it's currently, as you know, we just got a new number this morning. It's headline inflation is running very low. Core inflation, which strips out transitory food and energy components, is running at 1.2%. Our target for inflation is 2%. I don't see us getting back to target for a few years. So with that outlook, I think it would be inappropriate to remove accommodation in the near term, really through the course of the calendar year 2015. But, that's always dependent on the outlook. If we got new information that would indicate more inflationary pressures, I'd be happy to rethink that. But I certainly don't anticipate that at this time.
Well, how do you think the U.S. economy would respond if the Federal Reserve, the team of Janet Yellen, does vote to tighten rates this time around?
I am concerned that that would send a signal that the Fed is not fully committed to its targeted goal of 2% inflation. I think if you remove accommodation at this time, with inflation as low as it is, with it's expected to take so long to get back to target, I think you're sending a message that, well, we're not as serious about getting back to 2% as you might have thought. And you actually see the imprint of that kind of doubt in the behavior of market prices. So if you look at the difference between TIPS bonds and Treasury inflation protected securities and normal treasuries, 5 years to 10 years out, we've seen a steady decline in what people are anticipating inflation to be, going back over the past year and really near historical lows at this point.
I understand that you particularly focus so much on inflation and the lack thereof, but we just got a better than expected revision to second quarter growth, GDP, 3.7%. First time jobless claims are trending lower. Durable goods looked solid last time around. So why are we so beholden to China's weaknesses, global spasms, and things like that?
I think the U.S. has the benefit of being a very large and, to use economists speak, relatively closed economy. The main force for the U.S. economy is domestic. But to circle back to the numbers you mentioned, I think it's important to not just look at growth, but also to look at levels. And what I mean by that is we've seen improvement in the labor market. But look at the fraction of people who are aged 25 to 54, our prime age population, who have a job. That remains well below what it was in 2007. Even though we've seen improvement in that, there's more room for more improvement. And the inflation number is telling you the same story. There's room for more improvement than what we've seen so far.
I am hearing you say that.
And the Fed should facilitate that.
I think this is important that you're saying it's not just, oh, hey, we got a better than expected GDP. It's the level itself as it pertains to history. That, are you saying we're not that great here in the United States? Everybody keeps saying, oh, we're growing better. Yes, it's slow, but it's consistent.
I am an optimist in the United States, and that means that I think that there's room for more improvement than we've seen so far. And the Fed, I think, given our price goals, our employment goals, should be doing what it can to facilitate that further improvement. So we shouldn't be satisfied with where we're at.
I agree. We should never be satisfied. There's always room for improvement. But aren't there always going to be, let's say, market tantrums around the world? What we saw in China certainly affected our stock market. The Greek drama. We're no longer, and I guess the hawks would argue, we're no longer in emergency mode here in the U.S. So why should we hold to near zero emergency level rates?
We should adopt use our tools as needed to achieve our goals. So the right way to be thinking about the right stance of policy is not what the tool, where the setting of our tool, the interest rate tool, but where are we in terms of our objectives, prices and employment. I've told you about the inflation picture. We remain well below our 2% target, and we're not anticipated to get back there for several years. We remain, I think, below what we can be in terms of employment. So I think there's room for improvement in both in terms of prices and employment. And we would be, I think, robbing ourselves of a chance to facilitate that improvement by raising rates in the near term.
If you had your way, would you hold rates at this level till maybe even 2017?
I haven't thought as far ahead of that.
Late 2016?
Certainly, I have talked about in the past that I think the second half of 2016 is closer to where I'd be thinking about, but it's not a date-dependent issue, Liz. It's always about the outlook. Right now, if you ask me, I think as we get near the end of 2016, I'm optimistic that you'd start to see sufficient inflationary pressures that it'd be appropriate to raise interest rates.
Let's talk about your worries. But how worried are you about the strong dollar?
You know, my main worry is that we might have a conference 5 years from now about how the Fed made a mistake in raising rates, and that the United States is stuck in a very low inflationary, low interest rate environment as a result of that. I think that's my main concern, is about a monetary policy mistake. We've seen other countries make this mistake in the past, Japan, Sweden, and you know, I don't think we should we're immune to making those kinds of mistakes here in the U.S.
Okay, so let's be clear. If you were the sole decider at this next meeting, and you are not a voting member, but if you were the sole decider right now, would you go so far then as to even float the idea of more QE4, more quantitative easing, and if so, in what form?
Yeah, I think that we should be thinking about all the possible tools we have available for potentially facilitating more improvement in inflation and employment. So I'd certainly contemplate the use of those tools. But I think the more important thing is not about what we do at a particular meeting, but to send the message of what we're going to be doing in the future, that we're willing to stay accommodative in order, as long as inflation remains low, in order to try to push inflation up more rapidly. Just that message alone would lower real interest rates and stimulate growth.
The government has thrown a lot at this economy since the crisis. You know that. President Bush, of course, pushed through the $700 billion TARP bailout plan. President Obama has had all kinds of efforts. In 2008, you were one of about 270 economists who signed a petition protesting President Obama's stimulus plan, which did eventually pass. In hindsight, did that stimulus plan work, or do you still stand by your protest position back then?
So I thought that the communications at that point were a little too stark. That everyone agreed that a stimulus was appropriate, and I thought there was some disagreement among economists, and that was really more the source of my unease with why I signed that petition. One of the source of my unease. I think looking backwards in time, I think that it does appear that the stimulus had a positive impact based on the studies I've seen. I think the hole was a lot deeper than any of us anticipated, including those of us here at the Fed making policy.
Yeah, I can see why you're hesitant now to tighten rates. I really sense that with you. But now we're worried about market distortions, and that these low rates, near zero, have created, let me just use the B word, bubbles. Do you see a bond market bubble like some people do, or any kind of bubble right now?
You know, for me, the concern when I look at asset markets, I always look at everything. I'm sort of relentless about this, a monetary policymaker.
Sure.
How could this affect prices and employment? And what you're worried about, in terms of asset markets, is can the fluctuations in prices somehow translate into untoward downward movements in prices and employment that would be challenging for us to mitigate. We have a lot of people monitoring that, working on that in the Federal Reserve. At this stage, I just don't see the transmission mechanisms in place that would lead to adverse macroeconomic consequences from downward movements in asset prices.
So when you hear people like the Carl Icahns of the world, or some of the other real market participants worry about high yield bubbles and things like that, you say no?
I think they're asking a different question, because they're solving a different problem than I am. Mm-hmm. I'm always after, as I said, thinking about this through the lens of how is this going to affect prices and employment. If you're a market participant, I can imagine that that's not the way you're thinking about asset prices.
In the end, people who are watching right now just want to know if they're going to have a job in the next 6 months to 8 years, and will it be a better paying job than they have right now? I know that's a broad question and a real hypothetical, but do you see things looking better or worse in the next couple of months?
Oh, I think that the U.S. economy will continue to improve over the next couple of months. I think the issue is how much better can it be than we are right now. And as I said, I'm a real optimist about that. But I think we have to make the right choices to get that better future. And as I suggested, I think that those better choices don't include removing monetary accommodation at this time.
Oh, this is so interesting to me. Dr. Narayana Kocherlakota, thank you for joining us from Jackson Hole. We appreciate it.